about the banking sector, something which he has, I think, more wisdom than a lot of us put together here. Let me start, Mr. Sinha, with the question that today the banking sector in India is a very healthy looking banking sector. And you would remember 10 years ago when we had a twin balance sheet problem where banks, their NPAs, and the impact of that on growth was something that was worrying all of us. I'd like you to share with us this whole story and what you think are the key reasons which helped us get to this healthy banking sector today.
Good evening, Ilaji. Good evening, ladies and gentlemen. First of all, Ilaji, thank you very much for your very kind words. We have, of course, over the last decade, thoroughly transformed the financial sector in India, and particularly the banks, and more specifically the public sector banks. So it's really been a transformational journey over the last decade, as you know very well, because we were in the Ministry of Finance at the same time. The situation that we had inherited in 2014 was a very dire situation. And it was a dire situation for really three reasons. One, the most important factor was that many of the sectors that the public sector banks had lent to were actually in trouble. So the power sector was in trouble, the telecom sector was in trouble, the mining sector was in trouble. And many of the loans that the banks had made to those sectors were, as a result of that, non-performing, and that was obviously going to result in a lot of defaults and a lot of write-offs for the bank. So the sectors themselves were in trouble because of a lot of the policies that the UPA had followed, which were non-transparent and were quite arbitrary, which some were in fact struck down by the Supreme Court, as you all remember well. So number one, the sectors were in trouble, which meant the banks were in trouble. Number two, there was a lot of bad behavior in the banks themselves. They had overlent to these sectors. Of course, there was phone banking going on in the UPA where many loans that should not have been made were being made. And so therefore, the banks themselves were being run very, very poorly. And number three, the fact was that not just the borrowing practices, but also some of the strategies for the banks had resulted in several banks that were virtually in a situation where they had to be asked not to do any further lending. They were put under prompt corrective action. So a significant segment of the public sector banks, and you'll remember some of those banks that I will not name right now, literally had to be nursed back into health. So the banks themselves were in a situation where they virtually had to stop operations. So these were three interrelated set of issues that we had to take forward. That resulted in a very clear understanding. If you remember the Gyan Sangam that we did in Pune, where we decided to make some very deep structural changes to the public sector banks, and also to implement changes in the overall financial sector as well. And that was the start of the transformation journey. And that transformation journey, of course, also required 3 or 4 major structural interventions. Number one was the asset quality review that was undertaken by the Reserve Bank of India, where we literally had to stop the extend and pretend evergreening type behavior, and we had to call out the loans that were in default and make sure that those were exposed as far as the bank balance sheets were concerned. So that asset quality review was the first structural intervention. The second very major structural intervention was to make sure that the banks were properly capitalized. So over a period of time under Indradhanush, which Adhya Saab led, we had to make sure that we put enough capital into the banks and recapitalize them and re-strengthen them. The third very major intervention that was required was to ensure that the bank's strategies themselves were much more reasonable, that they were not overexposed to the corporate sector, and so on. The fourth major intervention was to actually get the sectors right. So we got the power sector right, we got the mining sector right, so we had to get those policies right, and only after we got the policies right could the banks then get back to health. And then actually there was a fifth thing also, The fifth was the consolidation process. So some of the weaker banks that were in PCA, etc., that could not really survive because we couldn't put enough capital into them and so on, were actually consolidated into some of the bigger, healthier banks as well. So really it was a 5-part program, fixing the sectors, changing their business models, capitalizing them sufficiently, consolidating some of the banks. All of those were actions that were undertaken starting out of Gyan Sangam. I think it was either in early 2015 or late 2014 that we actually began this whole transformational journey. And over the decade since then, all of these have worked in tandem to get us to the point where our public sector banks in particular, the financial sector as a whole, is really in very, very good shape and can now really power India's growth going forward.
So, another part of the policy that we had started discussing then in late 2014 was the IBC. And that was also to act as a deterrent. So in addition to the asset quality reviews and the things that the RBI started with, the IBC was to play a role in also acting as a deterrent more than anything else for banks to behave properly, for promoters to behave properly more than banks, but for banks to be vigilant and promoters to behave properly. How do you think that has played out?
You're exactly right, Ilaji, and I should have mentioned that also, because that's also had a very salutary and positive impact on our banking sector. So with the IBC, which was my great good fortune to pilot that legislation in the Lok Sabha and the Rajya Sabha, and I know you and others worked on it extensively. And then, of course, on the Standing Committee on Finance, we've also been privileged to make a series of amendments to the IBC code and look into it in great detail. So that whole set of reforms linked to bankruptcy have been very, very important for the banking sector, but because it has changed creditor culture in India completely. In the past, as you will all remember, as has been famously said, debt was equity and equity was debt. And so basically you could be in default and not pay any consequences for that. You could just go off and get another loan. That world has completely changed. So today, any promoter, any person running a company is deadly scared of getting into default, because that essentially means the company is taken over by the NCLT, it goes into receivership, and the promoter or the shareholders who are running the company basically are set to zero, and it's the creditors then that own the company. Just that one simple change of creditors taking over from equity holders has changed the entire behavior of all borrowers. So now borrowers who are deadly worried about losing control of the company are, of course, paying their loans on time and are avoiding default at all costs. Now we can, of course, strengthen and improve IBC in many different ways, which we've all seen and suggested, but the preemptive impact that IBC has is a little spoken about, but I think a tectonic change in India's creditor culture. The behavior of borrowers has fundamentally changed because they cannot and will not and do not want to be in default.
Absolutely. So, you know, the health of the balance sheets that we see today after all these years is to a very large extent coming from these policy changes. Now, looking ahead, India is going to be is already the fastest growing economy in the world and is going to be doubling GDP every 10 years or so. How do you see the banking sector serving this growth? What are the areas that you're happy with? What are the areas of concern?
So intermediation in India, I think, has to deepen, strengthen, and expand. We recognize that for India to grow, our advances, that is the debt outstanding, the loans that you're putting out, has to grow at somewhere between 1.5 times to twice nominal GDP. So if nominal GDP is running at, just for the sake of argument, assume 12%, then at a minimum, credit growth has to be 18%, at a minimum, to be able to power the economy. So we have to be making advances. Credit growth has to be at 18%, which it has been in the last year or two, which is part of the reason why we are growing as well as we are. But if we can do safe underwriting, that is, if we can give good loans, and that is not just 18%, but that is 20, 24%, if nominal GDP is 12%, that is, if we can get up to 2x nominal GDP, I think that will power the economy even faster and quicker. And that's what we have to do. So nobody is saying that you relax your underwriting standards. That is, credit policies have to remain robust, they have to remain prudential, they have to remain high quality. But even then, if we can continue to provide credit to all the areas that require credit, then we can really power growth forward. Now, as we do this, there are, I think, 3 very important factors that we have to keep in mind. Number one is formalization. If you look at MSME credit, for instance, you'll find that a significant amount of MSME credit is still in the informal sector. Similarly, if you look at agricultural credit, you'll find a significant amount of borrowing in the agricultural sector, particularly for small and marginal farmers, is in the informal sectors from money lenders, etc. In fact, there's some data that indicates that more than 3/4 of the borrowing that small and marginal farmers are doing is still from the informal sector. We have to formalize that. So number one driver of expanding credit and growing credit is formalization, number one. Number two is a range of different products. So right now we have a pretty good set of products out there, but as Sharad and others have worked on, can we do flow-based lending as well? So if we have to cover the informal sector, we have to get to a point where people are actually formalized, they have a tax identification number, GSTN, or other ways in which we can do more innovative financial products, many of which will have to be based on flow-based lending. So that's the second thing, more innovation, newer financial products, and so on. And number 3, which is the policy part of it, is can the government do more in terms of guarantees? And we found that when we've run guarantee programs, they've actually been very, very helpful. They've significantly expanded credit, particularly in the